Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Craig Yearman, manager of the Saracen Growth Alpha Fund. Hi Craig.
Morning, Emma.
So what's your first stock for us today?
The first stock for you today is a company called MJ Gleeson. Now, MJ Gleeson is predominantly a house builder in the north of England. So if you think of them, you think of affordable housing. So not social housing, but cheaper housing. Their average house sells for 125,000 and they build between, say, Newcastle and Stoke, Hull and Liverpool. That's their natural territory. And the reason we like the stock is the fact that their plot costs are the lowest in the industry. So their plot costs are roughly 9% of the overall cost. So therefore their margins are very good. They've got cash in the balance sheet, so they're financially secure, and they have a land bank stretching out for almost 7 years. So this company is in a very good position, but it's a niche house builder. So last year, to give you an example, they only built 750 houses. We believe over the next 3 to 4 years, that figure will go up to 1,500 houses. So the top line is growing, the bottom line is growing nicely, and they've recently started a dividend. So we believe that dividend will grow, possibly double over the next 5 years.
And some of the house builders have been hit by policy, this tax on second homes. But I think those are those that are exposed perhaps to the southeast of England, where buying a second home is more common. Have you escaped that with this stock?
Absolutely escaped that. The typical customer of MJ Gleeson is a husband and wife. And as I say, the average cost is £125,000, so it's really as far away from buy-to-let as possible to get. It's not southeast exposed at all, so this is a north of England house builder.
And what's the second stock today? The
second stock today is a company called Card Factory. Now, Card Factory, it's a vertically integrated general retailer, so it designs its cards, it manufactures cards, and then it sells its cards. Now, 80% of the stock is actually sold for less, 80% of the cards, should I say, are sold for less than £1. Their typical customer is female, will buy 35 cards a year, so for her, price is key. And what you find is when they go into town, whether it be Glasgow or whether it be a market town in England, they take out the local competition. So the local competition may be an independent company, it may be a Clinton's. Because their cards are of the same quality as, say, Clinton's, but much cheaper, they're able to drive that competition out of town.
And how much growth do you have with this stock? I mean, surely there's got to be a point where market penetration has been reached. There's only so many market towns, there's only so many stations where these shops can appear.
You would think so. They've actually got 8 years of self-funded rollout to continue. They open roughly 50 stores per annum. So they've got 8 more years. At the moment, they're not in the Republic of Ireland, they're only in the UK. The next territory that they intend to go to is the Republic of Ireland. So yes, we think that 8 years.
And what's the third stock today? The
third stock is a company called Tyman. Now, the reason we like Tyman is it's a geared play in recovery in the US housing market. Now, Tyman is currently earning margins of 14%. They believe they can get that to north of 20%. And in order for that to happen, we don't have to go back to the previous peak in the housing market. So just last year, there was about 1.2 million new houses in the US. They believe if that figure can rise to 1.5 million, which is way less than the previous peak, then margins will rise substantially. So that's a company that has a lot of self-help within it. They're very acquisitive. So they don't just have a US operation, they also have a European arm, and they also trade in the UK.
And this is a stock which puts the doorknobs, door handles, door sealants into new homes, isn't it?
Very much. It's absolutely that. It's knobs, knockers, seals. So it's very much a play into the new housing market, yes.
And I suppose the risk with this stock is that the US housing market falters. You say we're a while off the peak, but of course the last peak was what some say caused the global credit crisis. So how dependent on the US recovery are you with this stock?
We are dependent. And when I say we're dependent on the margin increasing. So if we look at the stock, I mean, the last year, as I say, was about 1.2 million new houses, which is not enough for the US market. So the previous peak was well north of 2 million. So we're not talking about going back to the extended times. We're just talking about more normalised times. And more normalised times in the US is approximately 1.5 million.
Craig, thank you very much.
You're more than welcome. Thank you.
This is Emma Wall from Morningstar. Thank you for watching.